Hi there, and welcome to our video on Leap Options, the best way to grow your income in the long run. Today, we're going to take a deep dive into what these options trading strategies are and how they work, specifically for beginners. Prepare yourself for an in-depth analysis of Leap Options. Leap Options, also known as long-term equity anticipation securities, are a type of options contract that have an extended expiration date. Unlike standard options contracts, which typically have a lifespan of a few months, Leap Options have expiration dates that can be as long as 3 years or more. These options provide investors with the opportunity to take a longer-term position on the price movement of an underlying asset. Leap Options offers several advantages to investors. Firstly, their extended expiration dates allow investors to capture potential price movements over a longer period, which can be particularly beneficial for those who anticipate significant market changes or have a long-term investment strategy. Additionally, Leap Options can provide investors with increased leverage, as they offer the right, but not the obligation, to buy or sell the underlying asset at a predetermined price, the strike price. This leverage can amplify potential gains if the price of the underlying asset moves in the anticipated direction. However, there are a few important considerations when trading Leap Options. Firstly, due to their extended expiration dates, Leap Options tend to have higher premiums compared to shorter-term options. This means that the initial investment cost for Leap Options could be higher. Additionally, Leap Options may have lower liquidity compared to standard options, meaning there might be fewer buyers and sellers in the market, which can affect their tradability. Lastly, it is essential to carefully assess the market conditions and the potential risks associated with the underlying asset before investing in Leap Options, as they can be highly volatile and may result in significant losses if the market moves against the investor's position. Example of Leap Options. Suppose you are interested in investing in XYZ Corporation, a technology company. The current stock price of XYZ is $50 per share, but you believe that the company has significant growth potential over the next 3 years. Instead of buying the stock outright, you decide to purchase a lead call option on XYZ. You purchase a lead call option with a strike price of $60 and an expiration date 3 years from now. This means that you have the right, but not the obligation, to buy XYZ shares at $60 per share anytime within the next 3 years. Now let's consider 2 scenarios. Scenario 1. XYZ Corporation's stock price rises if, over the next 3 years, XYZ's stock price increases to $100 per share. Your lead call option becomes valuable. You can exercise your option and buy XYZ shares at the predetermined strike price of $60, even though the market price is $100. You can then sell those shares at the market price and make a profit of $40 per share. Scenario 2. XYZ Corporation's stock price falls on the other hand. If the stock price of XYZ declines or remains below the strike price of $60 throughout the 3-year period, you are not obligated to exercise your option. In this case, your loss is limited to the premium you paid for the Leap Option. The advantage of Leap Options in this example is that they allow you to potentially profit from long-term price movements without committing a substantial amount of capital upfront to purchase the underlying shares. Additionally, the risk is limited to the premium paid for the option. The best way to grow your income in the long run. Leap Options. 1. Long-term investment outlook. The Leap Options strategy is suitable for investors who have a positive long-term outlook on a particular stock or asset. By purchasing Leap Call options, you gain the right to buy the underlying asset at a predetermined price within a longer time frame, typically 1 to 3 years. If your analysis suggests that the asset's value will increase over this extended period, you can potentially profit from the price appreciation. Example of long-term investment outlook. The long-term investment outlook refers to the analysis and evaluation of an investment's potential performance and growth over an extended period, typically spanning several years or even decades. For instance, suppose an investor is considering investing in a renewable energy company. The long-term investment outlook would involve examining factors such as the company's financial health, competitive position, technological advancements, industry trends, and regulatory environment. By assessing these factors and considering the company's long-term prospects, the investor can make informed decisions about whether the investment aligns with their financial goals and has the potential for sustained growth and profitability over the long run. A positive long-term investment outlook indicates that the investment is likely to yield favorable returns and provide value to the investor over an extended period, taking into account various foreseeable factors that can impact its performance. 2. Leveraged positions. LEAP options offer leverage, meaning you can control a larger position in the underlying asset with a smaller investment. This amplifies potential gains if the asset's price moves in the expected direction. However, it's important to remember that leverage also magnifies losses if the market goes against your position. Careful risk management and consideration of potential downsides are crucial to mitigating risk. Example of leveraged positions. Leveraged positions refer to investment strategies that involve borrowing money or using borrowed funds to increase the potential returns of an investment. For instance, an investor might decide to take a leveraged position in the stock market by using margin trading, where they borrow funds from a broker to buy more shares than they could with their own capital. If the stock price rises, the investor's returns will be amplified due to the borrowed money, resulting in higher profits. However, leveraged positions also come with increased risks since losses are also magnified. If the stock price drops, the investor could experience significant losses and may even be required to repay the borrowed funds. Therefore, careful consideration of the potential risks and rewards is crucial when engaging in leveraged positions. 3. Cost and time considerations. LEAP options typically have higher premiums compared to shorter-term options due to the extended expiration dates. The initial investment cost can be significant, so it's crucial to assess whether the potential gains justify the premium paid. Additionally, the longer time frame of LEAP options allows for more time for the trade to work in your favor, but it also means that time decay can impact the option's value. Monitoring the position and adjusting the strategy as necessary are essential aspects of the LEAP options approach. Example of cost and time considerations. In the context of a construction project, the cost consideration involves analyzing the financial resources required for materials, labor, permits, and equipment, among others. Time consideration involves assessing the duration of the project, including the estimated time needed for planning, execution, and potential delays. Balancing these considerations is crucial to ensure the project's feasibility and success, as exceeding the budget or missing deadlines can have significant repercussions on the overall outcome and stakeholders involved. Therefore, careful evaluation and planning are necessary to manage cost and time effectively. However, as with any investment strategy, it's important to do your research and consult with a financial advisor before making any decisions. We hope you found this video informative, and we encourage you to like, subscribe, and leave a comment below with any questions or feedback. Thank you for watching, and we look forward to bringing you more informative content in the future. And we'll see you in the next video.